In less than 30 months, Peloton lost $50 billion in market value, transforming from Wall Street's pandemic darling into one of the fastest corporate collapses in modern history. Deliver this hook in the first 15 seconds of the video to set an immediate, dramatic, and financial focus for the story that follows. John Foley launched Peloton in 2012 with a simple but ambitious idea: combine high-end hardware with a digital subscription model to bring the energy of a boutique fitness studio into people's homes. The original Peloton bike carried a $1,995 price tag, plus a $39 monthly fee for access to live and on-demand classes. This wasn't just exercise equipment. It was marketed as a luxury lifestyle product, targeting affluent consumers who valued both convenience and exclusivity. From the start, Peloton's pitch to investors centered on recurring revenue. Unlike traditional equipment makers, Peloton tied every bike to a subscription, betting that a loyal community would drive long-term growth and high margins. The company's early S1 filings highlighted this strategy, pointing to a business model where hardware sales brought users in and the subscription kept them engaged and paying month after month. Foley and his team didn't just sell a bike, they built a community. Instructors became celebrities, fostering a cult-like atmosphere that fueled word-of-mouth growth. Early buyers often described their Peloton as a status symbol, especially in urban markets like New York and the Hamptons. By 2019, Peloton reported over 500,000 connected fitness subscribers and hundreds of thousands of units sold, all underpinned by the promise of scalable, high-margin digital content. This foundation set the stage for Peloton's rapid financial ascent and for the extraordinary expectations that would soon follow. By fiscal year 2018, Peloton's financial engine was gaining speed. The company posted $170 million in revenue, more than doubling its top line from the previous year. That momentum carried into 2019, when annual revenue surged to $438 million. By then, Peloton had sold 548,000 connected fitness devices and boasted 1.4 million paying subscribers, numbers that gave Wall Street reason to take notice. On September 26, 2019, Peloton made its public debut on the Nasdaq, pricing shares at $29 and raising $1.16 billion in fresh capital. The IPO valued the company at roughly $8 billion, a striking figure for a business that was still posting net losses but promised high-margin, recurring revenue from its subscription base. Investors bought into the narrative of a tech-powered fitness revolution, betting that Peloton's blend of hardware, digital content, and community could scale far beyond its affluent early adopters. The company's filings painted a picture of relentless growth. Fiscal year 2020 closed with $882 million in revenue, up 102% from the prior year. Peloton's subscriber count and device sales continued to climb, reinforcing the belief that the company had tapped into a durable shift in consumer behavior. Wall Street's expectations were set high, with analysts projecting continued rapid expansion and an addressable market that seemed to stretch well beyond the home cycling niche. The stage was set for what would become one of the most dramatic surges in the connected fitness sector. By the summer of 2020, Peloton's order backlog had swelled to 175,000 bikes and treadmills. Demand was so intense that customers faced wait times stretching from weeks into months. The company's supply chain, built for steady growth, buckled under the weight of pandemic-fueled orders. In a scramble to deliver, Peloton spent over $100 million on expedited air freight in fiscal year 2021, an extraordinary logistics cost that slashed margins but kept shipments moving. Warehouses overflowed as the company ramped up production, pushing annual revenue to $4 billion for fiscal year 2021, a fourfold jump from the previous year. Subscriber numbers soared too, topping 2.8 million connected fitness members by the end of the fiscal year. Every operational lever was pulled. New fulfillment centers opened, manufacturing partners were added, and customer service teams doubled in size. But even as bikes and treadmills rolled off the line faster than ever, the backlog remained stubbornly high, a daily reminder that supply still lagged behind insatiable demand. The operational surge set the stage for Peloton's valuation to reach unprecedented heights. Peloton's ascent reached its zenith on January 11, 2021, when shares closed at $171.50, pushing the company's market capitalization to nearly $50 billion. Wall Street's enthusiasm was relentless. Goldman Sachs issued a price target of $160, projecting more than $6 billion in revenue by 2023. Wedbush went even further, setting their target at $175 and calling Peloton the Apple of fitness. Analysts described the company as a pandemic-proof juggernaut, with forecasts of 5 million subscribers and 30% annual growth in subscription revenue. The stock had soared more than 500% in less than a year, outperforming nearly every other consumer brand on the market. Media outlets ran headlines about Peloton's unstoppable momentum, while investor calls buzzed with talk of permanent behavioral shifts in fitness. On the trading floor, Peloton was no longer seen as just an exercise equipment maker. It was treated like a technology platform, with limitless upside. This was the apex of optimism, a moment when expectations seemed to defy gravity, and the company's future looked as bright as its soaring share price. Trouble first hit Peloton's balance sheet in the spring of 2021. On May 5, 2021, the Consumer Product Safety Commission announced a recall of 125,000 Tread Plus machines after dozens of injuries and a child's death. The company halted sales and faced over $100 million in recall and settlement costs almost overnight. As demand for home fitness cooled, inventory began to pile up. By June 2022, Peloton's unsold equipment had ballooned to $1.3 billion, more than double the previous year, leaving warehouses packed and cash tied up in idle bikes and treadmills. Days of inventory on hand soared past 200, a level that signaled severe oversupply. To move product, Peloton slashed prices. In January 2022, the flagship bike dropped 16% to $1,445, while heavy promotions on accessories drove average selling prices even lower. But the price cuts failed to spark a recovery. Gross margins collapsed, and the company posted a staggering net loss of $2.8 billion. For fiscal year 2022, its worst performance on record, the fallout extended beyond the numbers. On February 8, 2022, founder John Foley stepped down as chief executive officer and was replaced by Barry McCarthy, a former Netflix and Spotify executive. That same month, Peloton announced 2,800 layoffs, cutting about 20% of its workforce to stem losses. The company's rapid rise had given way to a relentless financial freefall, driven by safety crises, inventory missteps, and the swift reversal of pandemic demand. By 2023, the fitness industry had swung back toward its pre-pandemic center. U.S. gym memberships rebounded to 67 million, matching levels last seen before COVID lockdowns. Boutique studios and big-box gyms reported packed classes and rising attendance, a clear sign that the at-home fitness surge was losing steam. For Peloton, the external landscape had changed. Consumers were once again willing to pay for in-person experiences, and the hybrid workout model, part home, part gym, had become the new normal. Peloton's competitors seized the moment. Hydro, with its connected rowing machines, and Tonal, focused on wall-mounted strength training, both carved out loyal followings. Hydro kept inventory lean and built B2B partnerships with hotel and corporate wellness programs. Tonal doubled down on retention, reporting twice the engagement rates of broader home fitness brands. Meanwhile, lower-cost home equipment flooded the market, drawing price-conscious buyers away from premium offerings. Peloton's own numbers told the story. By early 2026, the company's market capitalization had shrunk to $2.25 billion, a 95% drop from its $50 billion peak. Fiscal year 2024 revenue landed at $2.7 billion, down 4% year-over-year. Connected fitness subscriptions hovered at 2.88 million, a 6% decline from the previous year. The focus shifted from growth to survival. Gross margins stabilized near 45% after aggressive cost-cutting, and inventory days fell below 90 for the first time since the pandemic. Cash burn slowed, but the path forward depended on a handful of key metrics: subscriber churn, device sales, average selling price, and free cash flow. As Barry McCarthy's tenure drew scrutiny, analysts debated whether Peloton could ever reignite demand or if the company would remain a cautionary tale of pandemic-era exuberance. Today, Peloton trades at under $3 billion and is down over 90% from its peak. In a market that rewards scale and punishes missteps, investor euphoria can vanish overnight. For every new disruptor, the lesson is clear: momentum may be priceless, but gravity always returns. What is your take? Share below.